Thank you, Mr. Richard, for your 15 years of service. We are letting you go due to your age. You are too old. It's due to your work performance. You have not been meeting performance targets. Us letting you go has absolutely nothing to do with your age. We hope you find a better job. Goodbye.
According to the Schwab Center for Economics Policy Analysis, more than half of unemployed Americans over the age of 50 are at risk of involuntary retirement. And if you are still below the age of 40, no worries. You are still considered a young worker and it will not affect you too much. Even if you lose your job, you can easily find another one. But if you are over 45, you need to be worried about your job and your age. Even though age discrimination is illegal, it still happens. When the company doesn't want a senior worker, they'll find other excuses to fire you. Even if you want to work to 65, you may be asked to leave the company at 50. At 50, it's next to impossible to find another job due to your age. You have no choice but to retire early. Early retirement is no longer a choice. That's why it's important that you start planning for it right now, regardless of your age. And investment will be the key to doing that. Here are top 5 investment strategies for retiring early. Strategy number 5, market timing. Timing the market is tough. Market timing is not just about trying to pick the stock prices, peak and bottoms. Value investing, momentum buying, stock picking are all variations of market timing. Have you successfully timed the market? If you did, congratulations to you. Was it by luck? Could you repeat that success and do it consistently? For most of you who tried to time the market, chances are that it didn't go too well for you. As an everyday investor, this simple concept is critical. The stock market can be quite volatile. Timing the market causes investors to earn less on average than if they did not try to time it. Research by S&P has shown that full-time professionals who specialize in investments underperform the benchmark most of the time. This article shows performance statistics from actively managed funds, and as you can see over 15 years period, 91% of professional market timing funds underperform the benchmark. Luckily, you can still participate even if you are unable to time the market. Research by Charles Schwab has shown that you don't have to be a market timing expert to be profitable. A dollar cost averaging strategy works sufficiently well. Instead of trying to time the market, time in the market is far more profitable. There are hundreds of articles on this interesting phenomenon, and it's really important for one to understand when you're investing. Strategy number 4, researching. Some of you might choose to cherry pick individual stocks. If you're going to invest in individual stocks, it is critical to do your own research and understand what you are buying. I encourage investors to be their own stock analysts. Too often, we get caught up in overhyped stocks and buy without doing a single ounce of research into the company. You may conduct a top-down analysis of a stock by starting with an industry and then finding the best performing businesses, or you can do a bottom-up analysis by starting with a company and then learning about the industry's future by looking at the company's quarterly and annual reports. You can study their financial statements, balance sheets, valuations, and business strategies. The main message here is that you should not rely on what others say or recommend, but rather use it to jumpstart your own investigations. If you are watching this video, you probably would have watched other content creators' videos where they discuss and recommend their top stock picks for the month. But note, these are just random people on the internet spewing out their own opinions and interpretations. And that also includes myself. They do not know your financial situation and your risk appetite. So it's important to supplement others' opinion with your own. It's perfectly acceptable to disagree with someone, and it's also great for you to grow as an investor when you learn to interpret the numbers on your own. Strategy number 3, start investing early. If I could turn back time, I would start investing much earlier. Research has repeatedly shown that when you started investing matters far more than how much you invest. The number of years you spend in the stock market has an exponential effect on your growth and profits, because being in the stock market for a longer period of time gives you the benefit of compound growth. Let's do some calculations. Consider two people. The first person invests $200 per month at the age of 25. The second person only starts the $200 per month investment at age 45. The person who starts at age 25 contributes $96,000 in total, but his portfolio is $500,000 by retirement age. The person who starts at 45, on the other hand, contributes $48,000 in total, but their portfolio is worth just $100,000 by retirement. So because the first person has been in the market twice as long as the second person, he has multiplied his portfolio by 5 times, while the second person only just doubled it. Each year you delay investing, you lose 1 year of exponential growth. Sure, you may be thinking the $5,000 you put in might only pay you $400 the next year. But if you start early enough, it will make you around $4,000 per year in 30 years. So you can see here, the longer you stay in the market and the longer you are invested, the more impact it will have years down the road. It will result in hundreds of thousands of additional growth as you get older. So if you haven't already started investing, do make it a priority when you have the funds to do so. You don't have to invest a lot, but the key is to start early. Strategy number 2, exchange traded funds, ETFs. Have you heard of ETFs? You just started, you will realize that you will never be able to know as much about the market as professional traders because there are countless factors that you probably don't have the capacity to keep track of. Companies are extremely difficult to predict and understand. However, there is one thing that everyone can count on, and that is the fact that the US economy will grow over time. If you look at the numbers, the average annual return for the S&P 500 historically has been 6 to 12%. And if you look at year-to-year growth, most years are positive. Along the way, we do see some major corrections. The thing is, we never know when this correction will come, but if we just keep investing for the long term, it doesn't matter. Some businesses like Google, Apple and Tesla has done very well. Their stock price has appreciated tremendously. Of course, most of us will only know this information on hindsight when the news brings them to our attention. We would most certainly like to have them in our portfolio, but the problem is that it's difficult to spot them in advance. But no worries, there is a very simple solution. The solution is simply invest into a basket of many different stocks. That's where index funds come in. Investing in index funds is similar to investing in the US economy. You can also think of the whole US economy bundled up into a single ticker as if it's an individual company. This company has an unbreakable track record of decades of growth. With this thought in mind, a large portion of your money can be invested in index funds such as Vanguard's S&P 500 ETF. It's important to ensure that you are using exchange traded funds, ETF, that are traded on the stock exchange and they do have a ticker symbol. Do not invest in non-exchange traded funds. This way, you do not have to worry about liquidity. For example, you can consider the ticker symbol VOO. For more information, you can check out my other videos. And this brings us to strategy number 1, capital gain tax. Last but not least, I'd like to discuss about capital gain tax. The truth is that most new investors like to buy in and out of stocks often because it is more exciting. Instead of thinking that investing has to be super fun and exciting, we should think of investing as having to be boring. This could definitely help a lot of people who get caught up in day trading and trying to predict day-to-day market movements instead of just buying index funds and holding them. The trouble with consistently buying and selling stocks is that you'll be slapped with a lot of taxes anytime you sell a stock for more than what you paid for it. This also applies to many other investments like real estate, as long as you make a capital gain on it. If you're lucky to be residing in another country with no capital tax gain like Singapore, then good for you. You can make all the capital gains you want and the government will not tax you a single cent. But if you are residing in the US, chances are that you will be subjected to capital gain tax. The US tax law differentiates between short-term and long-term capital gains. You will make short-term capital gains if you sell an asset that you have held for less than a year, and long-term capital gains if you sell something that you held for more than a year. There is a significant tax difference between these two situations. So let's look at it. When you sell a stock that you own for less than a year, it's taxed as ordinary income, which means you'll be taxed at a rate of 10 to 37% depending on how much you make per year. And you may also have to pay state tax on top of that. When you sell a stock that you own for over 1 year, the taxes you pay are almost always lower. Take a look at this chart to see how much you will pay depending on your filing status and how much profit you are taking. If you have long-term capital gain, you either pay 0, 15 or 20% tax. If you have short-term capital gain, you'll be subjected to 10 to 37% tax. The tax treatment for long-term capital gain is more favorable. This is why investing long-term is beneficial, because you have less stress and you will pay fewer taxes on your capital gains. As an added bonus, when you trade lesser, you are going to pay lesser in your brokerage commissions. When you have a long-term view, it's going to be a triple benefit for you. Most people don't think about this when it comes to stock, but it may have a big impact on your yearly tax bill and investment plan. So that's something that we need to think about. For more information on taxes, check out my other video over here. Agree or disagree with this video? Leave a like, subscribe and comment down below, and I'll see you in the next video.